Good morning, everyone. Welcome and thank you for joining us for our second engagement on Rand rates reform. Please note that the session will be recorded and the recording made available to the webinar participants. My name is Douglas Hendry and I look after Treasury and Capital Management, or TCM, for the Standard Bank Group. Joining me are my colleagues, Paul Burgoyne, Treasurer for the Standard Bank of South Africa, Wani Intakeni, who looks after balance sheet management in Paul's team, Carol Horton from the Group TCM team, who has responsibility for the transition project from an internal Standard Bank perspective, Kim Oliver from the Global Markets legal team, and then Kate Lewis from our investment banking team. Most of you by now should be familiar with the drivers behind rates reform both globally and in South Africa. You will also know that the South African Reserve Bank has chosen ZARONIA as the successor rate to JIBAR. The purpose of this session is to provide participants with key industry updates, which includes the latest timelines and milestones, key differences in the way ZARONIA will work in practice compared to JIBAR, and how we believe clients should be preparing themselves for the transition with a focus on what we deem to be the most important considerations. Lastly, we will provide responses to specific questions received from clients. Please also note that there is a Q&A tab where you can post questions during the session, which we will then attempt to answer during the Q&A session at the end. I will now hand over to Wani to cover the key industry updates.
Good morning, everyone. Now, with ZARONIA having been selected as the replacement rate for JIBAR, this process actually of selecting this rate was following a period of over 5 years where the rate was back-tested, and the back-testing results proved to be positive, yielding positive results and showing that ZARONIA is fit for purpose and sufficiently stable and aligned to policy rate changes. ZARONIA is a backward-looking rate and is based on actual transactions that are reported to the SARB on a daily basis. With the observation period having ended last year in 2023, the rate is now available to the market for use. Now, if we just look into our industry timelines in terms of where we are, we have concluded the foundation period, which ended last year at around November 2023, and we are now in the adoption phase. Now, during this adoption phase, market participants should expect some few key milestones to be met. The most important for market participants will be ZARONIA first. Firstly, it will commence with new derivatives, which is likely to commence in the first quarter of 2025. Thereafter, we should expect ZARONIA first for cash markets to follow suit. We're expecting, based on the industry milestones, that this should kick off by second quarter of next year or towards the latter end of that quarter. The investigation of term rates has commenced, and we're expecting the investigation to be concluded and recommendations to be issued in Q2 of 2025 as well. What's also important to note for market participants during this period is that we should expect some feedback with respect to the ISDA fallback methodology and an agreement on whether that is suited for the South African market or not. Also important to note as well is that we should expect credit adjustment spreads, or the methodology of credit adjustment spreads, to also be announced as well. Now, if we just look to the next slide in terms of some of the key industry updates that have happened during this adoption period. The joint communication by the Financial Service Conduct Authority as well as the Prudential Authority was issued, and this really mainly impacts on financial institutions. And the purpose of this communication is really just to convey a message, the Prudential Authority's expectation for financial institutions to get ready for JIBAR cessation. This is known as the DRC or letter in the international market. In our market, it's often referred to as the joint communication. What's also important also to note during this period is that the ISDA fallback methodology protocol that is currently being investigated by the Credit Adjustment Workstream, which was set up by the Market Practitioners Group. The purpose of this workstream was to investigate or to confirm whether the ISDA methodology is appropriate for the South African market or not. If not, an alternative recommendation will need to be put in place. The Credit Adjustment Working Stream has documented its findings and its recommendations, and these are currently being considered by the NPG. On the 12th of September, the London Clearing House became the first central clearing counterparty to introduce clearing capability for ZARONIA overnight index swaps. Standard Bank, ABSA, Investec, Nedbank, as well as RNB were the first participants to clear ZARONIA swaps, with Deutsche Bank as well as JP Morgan acting as clearing brokers. Now, as we begin to transition from JABA into ZARONIA, it's very important for us to take into consideration that there may be differences in terms of methodology as well as characteristics of these rates. The table or the graph to your left shows the movements of ZARONIA compared to repo as well as JABA. ZARONIA, being a near risk-free rate, generally tracks the movements or the changes in monetary policy rates. In the South African context, the monetary policy rate is repo. On the other hand, JABA, being an unsecured rate, anticipates movements or changes in monetary rates or expectations in terms of what the repo will actually change in the near future. JABA is an unsecured rate, and built in it is a credit and term premium component in it, which is associated with the demand and supply for wholesale funding. It is forward-looking by its nature, whereas ZARONIA, on the other hand, is backward-looking and is calculated on a daily, is an overnight rate rather. The calculation of JABA is based on submission by contributing banks, and currently 5 contributing banks submit their expectation of the rate to the South African Reserve Bank, and it's through that process that JABA is actually determined. On the other hand, ZARONIA is actually based on actual transactions that will be reported to the SARB on a daily basis. And it actually allows for a broad array of market participants as well. These fundamental differences between JABA and ZARONIA need careful consideration in transitioning legacy JABA-linked contracts. Now, differences between JABA and ZARONIA can give rise to a transfer of economic value between parties when transitioning legacy JABA contracts, and this should be avoided where possible. A credit adjustment spread can be incorporated to mitigate against the risk of transferring economic value when transitioning JABA legacy contracts to ZARONIA. To your right, you will see that we have included a diagrammatical representation of the relationship between JABA as well as ZARONIA. An existing JABA-linked contract with a margin will transition to ZARONIA plus a credit adjustment spread. It's important to note that this credit adjustment spread is an adjustment to the reference rate. The margin should be expected to remain unchanged. On the other hand, a new ZARONIA transaction will reference ZARONIA as its base reference rate, but the margin could be different as compared to a JABA-linked contract. And this difference will probably be to account for the difference between ZARONIA as well as JABA as well. Credit adjustment spread is a static adjustment made to ZARONIA to cater for this risk, and it can be disclosed separately or alternatively incorporated into the total margin of a transaction. If we just move on to the next slide, where we will look at a practical example of what the interest calculation could look like between a 3-month JABA-linked deal as well as a transitioning deal. The table to your right shows the hypothetical financial economic that could actually be observed as a result of the fact that there's a difference between 3-month JABA as well as ZARONIA. In the second column, we look at an existing JABA-linked product, an example of an existing JABA-linked product, referencing 3-month JABA plus a margin of 1.5% above JABA. The all-in interest rate is 9.54%. Should this deal transition to ZARONIA, a credit adjustment spread, which in this instance is a hypothetical spread of 0.2% or 20 basis points, will be taken into consideration in order to actually transition the deal. You will note that the margin remains unchanged. However, the all-in rate may differ slightly compared to what a JABA-linked product would have actually calculated. Likewise, if we actually look at a new ZARONIA product, we're also referencing the same ZARONIA as the deal that was transitioned. You will note that there is no credit adjustment spread. However, the margin could actually be different to that as compared to a JABA-linked product or a deal that transitioned. Worth noting here that in this example, we've assumed that the margin increases by 20 basis points or 0.2%, and that is the reason that it's 1.7%. Again, you will note that the all-in interest rate of 9.57% will differ to that of a JABA-linked product. These fundamental differences will become very important as we begin to prepare for transitioning as well as starting to actually contract a new JABA-linked, new ZARONIA-linked products. If we move on to the next slide, There are some new terms that are being introduced by us moving into the ZARONIA world. And these are very important given the fact that the various MPGs or market practitioners group have made the recommendations for the various products. Some of these terms include the rates set in arrears, the look back, as well as observation as well. So it's important for us to actually just define what this actually will mean for the various products, because different products as well as different markets may have different rate conventions as well as methodologies. In the next slide, we will start by looking at what is the difference between a simple and a compounded rate, because both can apply to ZARONIA. A simple rate is effectively a rate interest that is calculated on the principal amount only. In other words, on a daily basis, the interest will be calculated on the principal without compounding. On the other hand, a compounded rate, this is where interest is charged on interest. In other words, the interest that is levied includes interest on interest. This is different to the simple interest rate methodology, where the interest accrual is actually only applied on the principal amount only. Both rates will be set in arrears. In other words, the rate will only be known at the end of the interest period. The simple interest may be easy for systems to actually implement. However, the compounding of a daily rate may introduce some complexities to systems and thus requiring changes to systems in order to be able to accommodate this calculation. Now, there is a new term also called look back, which is important in order to account for the fact that these rates are being set in arrears. And look back permits a lender to determine the interest rate for the interest period before the interest period ends and the interest payment is due. This provides the lender with enough time to notify the borrower of the interest amount that is due. For example, a look back with 5 business days means that the interest rate to be applied during the interest period will be calculated 5 business days before the interest period ends. Now, in terms of the recommendations by the various market practitioners groups, the general methodology or general consensus is that we will apply a look back without observation shift. Now, it's important for us to understand what observation without observation shift means. This entails that means, for example, in a 5 business day look back without observation shift, this means that the interest for a business day will be based on the rate that was published 5 business days earlier. In other words, if we were looking at calculating interest today, the rate to be applied today will be the rate that was observed 5 business days ago. And that will apply for each and every single business day until such time as you come to a non-business day, in which case the latter rate that was observed will be used for the non-business day. For example, the rate that will be observed on Friday or used for Friday will then be applied for Saturday and Sunday. And thereafter, Monday will then revert to actually using the 5 business days. I hope you found this useful. I'll now hand over to Paul, who will now take us over the client insights.
Thanks very much, Fawani. I think that's such an important section because it deals with a lot of the complexity that's being introduced with ZARONIA. And that's very much in line with what we've seen globally with reference rate reform for the major currencies that we deal in with as a bank. Part of the transition is really around considering what elements you need to be looking at within your firm to manage this transition away from JIBAR. Importantly, putting the right governance in place, putting a framework for understanding the exposures, providing visibility to senior management is important. Certainly from a Standard Bank perspective, we have a governance work stream that reports all the way up to our board and is represented by all the business units, given the exposures that we have for JIBAR across the bank. Identifying exposures is very important as well, particularly at this point in time. We'll look at a timeline shortly on where we should be, but at the moment we should be identifying what JIBAR exposures we have, and certainly the bank will be in communication with our clients around the exposures across different products. But exposures can manifest in various ways. You can get exposures just legally in contracts. You can have JIBAR in your valuation models, that you might be using for measuring fair value of financial instruments, as an example. And even for certain fixed rate loans, they may revert to JIBAR later in contracts. So it's important to look at the detail when identifying potential exposures to JIBAR. Certainly, ongoing monitoring of exposures and what transition is likely to look like. Bawani's provided the framework for what transition will look like. We will shortly have credit adjustment spreads available for observation in our market, and that will give a sense of what the new interest rates would be were you to transition. Legally, there's an exceptional amount of work that's been done within the South African market to develop the legal frameworks across the various products. That information has been supported by the key international bodies being the LMA, ICMA, and ISDA in terms of developing the key legal language, both for transition and for new contracts. It is a lot more onerous and a lot more complex, but certainly the banks are preparing and the legal firms are preparing to be able to input that new language into transactions. From a communication perspective, certainly the SARB, the banks are providing a lot of information to clients. We have a full communication work stream internally, so our client teams should be able to support this transition and answer questions that you have. And there's a lot of external communication. We'll share some insights on that later in the presentation. From a product perspective, I think Bawani's touched on some of the complexity that exists. Making sure that your systems, your accounting systems and product systems can handle the interest calculations is going to be an important step. And ensuring that you have adequate time. Legal renegotiation can take time, updating your technological infrastructures, and making sure that teams have the right skills to manage this transition is also important. With this change, there's a potential for additional disclosures. Certainly, if you have material exposure to JIBAR in your financial statements, as well as understanding potential accounting impacts like hedge accounting, and whether any of these transitions gives rise to any tax consequences. So those are important aspects to consider as well. Just perhaps mapping that to where we are from an industry timeline perspective. So what should we be doing now and what should we be thinking about? Certainly, we've got to a stage where we are dealing with having adopted ZARONIA. The ZARONIA is now in place, and we're at a point where the product sets have been defined across key products, money markets, loans, derivatives, and bonds. And already we're seeing some trading starting in derivatives. It's important that we get the derivative market up and running and liquid, and that will help us price new fixed rate transactions, but also provides an impetus for adoption in the cash market. We expect a derivatives first initiative, as Bawani mentioned, to kick off in February next year, and more detailed announcements around that will come from the MPG during the period during November and December. In terms of the apologies for that interruption. My internet dropped off there. In terms of where we are, we're in the phase of adopting new products, enabling ZARONIA trading. As I mentioned, we're starting to see derivatives trading in the market and liquidity to build up. I think what is happening across the key products is the MPG work streams are really trying to push for ZARONIA to be used first at various points in time. And for the derivative market, that will begin in February next year for linear derivatives, so swaps and FRA type instruments, and then ultimately into cross-currency swaps and non-linear derivatives, so options as an example. From a cash market perspective, that will follow shortly thereafter. So we would expect that banks would be able to transact in ZARONIA for new instruments from the second quarter or the middle of next year. And certainly that'll help with price discovery in the market and where we see new margins set for new transactions. The cessation announcement is important for the reason that it crystallizes or sets the credit adjustment spread in the market. The credit adjustment spread is, as Wani mentioned, how we will transition from JIBAR instruments to ZARONIA plus the credit adjustment spread to amend the base rate within floating rate transactions. That crystallization is important as it provides certainty on what the new interest amounts will be going forward, or the new margins will be going forward. So I think there'll be a lot of client engagement with our transaction teams. That will be channeled through your client relationship managers. And where you have multiple products, it's important to consider those products and transition probably at a similar time, and the bank will certainly be able to support that and have the necessary discussions. At an industry level, we remain very involved in the MPG across all the major work streams and are driving the transition planning and coordination work stream that pulls the whole transition together. We provided a link, and we'll share this presentation, to some very useful information. The Standard Bank ZARONIA page has a large FAQ section that deals with a lot of the background and some of the detail that you need to understand. And the MPG website on the SARB website certainly has a lot of information. The key industry bodies, LMA and ISDA, have also got important information around contracting and impacts to loan and derivative markets. So if you do have any queries, please reach out to your client coordinator or your client team who will be able to assist you in that regard. I'll hand over to Carol now for questions. Thanks.
Thank you, Paul, and good morning, everyone. So to kick off the Q&A section, I have collated some of the recent and commonly asked questions, which I thought helpful to share to kick us off. I will direct the questions to our SMEs around the table accordingly. The first three will be directed to Paul. These will address what Standard Bank is doing in preparation for this industry transition, the clarification of cessation announcement date, and an update of the term rate consideration. Back to you, Paul.
Thanks, Carol. So I think we covered a lot of this in the previous section. So certainly Standard Bank's very involved in the industry level in driving this transition. There's a lot of activity across derivative cash markets, dealing with the product aspects of getting up and running for ZARONIA. The work on the credit adjustment spreads, as Wani mentioned, is near finalized. And there are a number of governance issues that are being dealt with. One of the key issues is how do we deal with tough legacy contracts? And that's being dealt with through the governance and legal work streams. Tough legacy contracts are really where it's difficult legally to transition based on how contracts are written. And there may well be some legislative requirements that enable transition to take place. A good example might be in the bond market, where note holder consent is required, or a high percentage of note holder consent is required in order to transition. And if that's not feasible, we may have some difficulties with JIBAR-linked transactions post the cessation date. The JIBAR cessation date is not finalized yet. The indicative plan, as published by the MPG on the SARB website, has got a proposed cessation date of end of 2026, basically. That's important because it provides some impetus to drive this transition, to start using ZARONIA new contracts as soon as possible, and allows for a timeline of the cessation announcement to also be set. So that cessation announcement, as I mentioned, is planned for the end of 2025. You may ask, why has cessation not been announced already? I think if cessation were announced, it does kick off potential legal consequences in transactions, as well as disclosure and reporting requirements. And so I think there's a deliberate scheduling of that to provide the market with some certainty around when that cessation would be announced. Will there be a term rate? We've discussed on this webinar the complexities of compounded overnight interest, the system requirements. There's work going on by the MPG to look at a framework for establishing term ZARONIA rates. It's not to say that these will be ready by the time cessation takes place, or by the time we're expected to start using ZARONIA in new transactions. So the framework is based off ZARONIA derivatives as the underlying inputs into perhaps a 3-month term ZARONIA rate. What we require for that is sufficient liquidity to build up in derivative markets in order to be able to support derivative trading, to be able to underpin a term ZARONIA rate. So I think we feel it would be desirable to have term ZARONIA in certain markets. In the retail market will be important, where JIBAR is currently being used. We have seen internationally, though, that term rates have been limited in their application. For example, in derivative markets, term rates are not used in the interbank trading market, are really there to facilitate client trades and client hedging. And so there are certain limitations, and there'll be more information around term rates coming through 2025.
Thank you very much, Paul. The next few questions are legal related, and I will direct these to Kim. These will cover the fallback language clarification, the legal impact of the transition, and the processes to follow. Thank you, Kim.
Thanks, Carol. So the term fallback or fallbacks or fallback language has been used a few times during the session. So what is fallback language? I mean, we get this question all the time. So, with the discontinuation of engagement rate, such as like we've seen with LIBOR and now what we've seen with JIBAR, that would inevitably have an impact on entities. I mean, they will continue to have exposure to this rate after it becomes unavailable. So from a contractual perspective, the question is, how do we address this? How do we address this risk? So what parties or entities can do is they can include language in the agreements which specify a replacement rate. For example, ZARONIA, which has been endorsed as the replacement rate for JIBAR. And that rate would automatically replace that discontinued rate upon the occurrence of a specific event or an agreed upon date. So what we've generally seen, I mean, with LIBOR particularly, was that most parties had agreed to fallbacks with a trigger or an event being the event that they actually transition, being the discontinuation date of the rate of, the relevant LIBOR. So, I mean, that's more or less what we've seen in agreements. There are two fallback approaches, the first one being what we call the amendment approach. So this is more what we see as we've seen in contracts as very generic language that is used. There is a reference to a replacement rate, not necessarily specifying what that rate is. It's usually, parties will determine that at a later date, etc., and that could be for various reasons. It also includes broad parameters of how and when the replacement rate will be determined, applied, and effective. So the details or the specifics around the methodology that would apply to the replacement rate, conventions that have been mentioned already, or any adjustments such as the credit adjustment spread, etc., that is agreed or determined at a later date. So what this means, if something is agreed at a later date, that means that it has to be amended again. So that's an interesting discussion in terms of the South African context, because we do see this as an agreement to agree. But I think if parties do take this approach, it does show the intention of the parties, that they do intend, there is consensus that they would like to transition to a new rate, a replacement rate. The hardwired approach is very different in that it would include the actual replacement rate in your language. For example, ZARONIA upfront. That would be agreed upfront, as well as all relevant terms related to the replacement rate. So it would include the details around the methodology, how you calculate ZARONIA, any applicable conventions or adjustments, and including the credit adjustment spread. So very specific, very clear, and very concise in terms of what you're agreeing to. And like I said, in both approaches, the new rate will replace the existing rate at a specific agreed date or upon an event. Another question that we also see is, what is the legal impact and process? So, the first, I think the big one that everybody is asking about is what happens to our legacy agreements that currently, reference JIBAR, the JIBAR-linked contracts. So the easy one, counterparty or entities will have to actually do an analysis and determine and identify which agreements would actually, which of their legacy agreements would expire prior to cessation. If your agreements expire, those that reference JIBAR expire prior to cessation, mature prior to cessation, there's actually nothing that needs to be done because, post-transition, the agreements, the transaction would have matured. So no action is required. You can keep those agreements in place. Where it becomes a bit more difficult or more challenging is where your agreements actually, mature after the cessation date. So you have an agreement that references JIBAR, but post-cessation, JIBAR still would exist, would still be referenced in your agreement, even though it's been discontinued. So there's two approaches that can be taken here. The one is where parties can actively amend their contracts to replace JIBAR with a new agreed rate. So the rate being, as we know, is endorsed and what most people are looking at is ZARONIA. Parties can actually agree that, so they can move immediately from JIBAR to ZARONIA if they are ready. I think it's also encouraged to also look at the milestones that have been prepared by SARB in determining, when you should do that. The other option is contracts that are updated with fallback language. I mean, I've spoken enough about what fallback language is, but I think the key there is that if counterparties and entities are not ready to transition, there's still work to be done. You can still include this language and agree a later date or agree that the transition will only automatically take place on the actual cessation of JIBAR. So if none of these approaches work, I mean, that's where you have your difficult, contracts that are difficult to amend, specific type of transaction, or cannot be amended in any way, or the fallbacks are not appropriate or suitable. There is this concept of tough legacy contracts, which Paul did also touch on. I think there's still some work to be done locally in terms of, a clear definition of what a tough legacy contract would look like. I mean, I think there will be, there is currently being legislation, primary legislation has been drafted, and which should include, more about the scope and details, which has been determined by the various working groups and the regulator as well. ZARONIA link contracts would just be simple. These are all your new contracts where you can just reference ZARONIA and it's business as usual. It's not necessary to transition in respect of those contracts. The next question, which we've also seen, and this is specific to, when you're contracting, or what we've also seen also with LIBOR, the LIBOR transition, is, is there any standard fallback language being published for derivatives, cash and bond markets? So many of you may be very familiar with ISDA, the International Swaps and Derivative Association, and the work that they've done. There's been a significant amount of work that has been done by ISDA, and they've also been working very closely with our regulators. I think there were a lot of learnings also from LIBOR, which we benefit from. So if the ISDA credit adjustment spread or the methodology is actually approved, JIBAR fallbacks will be published in two ways by ISDA. It'll be published under 2021 ISDA definitions. So that will be all new derivative contracts which reference the 2021 definitions and entered into after the date that the fallbacks have been published under those definitions will automatically incorporate the fallbacks. So there's no further, action required from counterparties. As long as your contract references the 2021 definitions and it's a new contract that's published post the publication of those fallbacks, they will automatically incorporate the new fallbacks. Unless parties don't feel that these are, they do not feel that the fallbacks they don't agree that the fallbacks will be suitable for that transaction, they can also bilaterally amend or contract out of those fallbacks. The other approach that is looked at, and this is specifically is the fallback protocol. It's got the same, I think, the same idea in terms of, contracts will automatically transition. If you do adhere to the protocol, that's important. But this applies to legacy contracts, legacy derivative contracts, or legacy derivative contracts. So we're looking at contracts that, reference 2021 definitions, earlier sets of definitions, because there have been a few sets of definitions published by ISDA. So it will also likely cover your GIMRAs and GIMLAs. So all your legacy contracts, entered into before the publication of the fallbacks in the protocol will be covered by the fallbacks if, and this is a very big if, both counterparties adhere to the protocol. And that is you can do that via the ISDA platform. I mean, there's volumes of impacted derivative contracts. So I think, like we've seen with LIBOR, the protocol adherence has been encouraged, and it's very important to ensure a smooth transition from an existing rate to a new rate. Like I've said, the incorporation of the ISDA fallbacks and through the 2021 definitions and the protocol will result in contracts automatically transition to ZARONIA as per the fallback provisions on the date that JIBAR is discontinued. And this automatic transition means that it is a passive transition because you do not need to amend your agreements. Nothing else needs to be done. As long as your agreement is referencing your 2021 definitions, or for legacy contracts, you've adhered to the protocol. There's no further work to be done there. So the ISDA fallbacks are hardwired, which I've already explained. International Capital Markets Association, I mean, they've been working in respect to the bond market and also been, working closely with our regulators. And they have been providing guidance, on the approaches that were taken, what to look at, what needs to be considered. We're not aware of any industry standard fallback language that has been published by ICMA. So I think that would be need to look at a case-by-case basis, or something that it would still be discussed in terms of, how we move that forward from a contractual perspective. Finally, the Loan Market Association, the LMA, I mean, that's the loan, the work of the loan market that's been done. That also a lot of work, lots of learnings from LIBOR that has occurred, which we're very fortunate. And the LMA have been working again very closely with our regulators. So a while ago, they did endorse the screen rate replacement language, for the loan market. And this is more that generic language I was referring to earlier. So, I mean, they don't refer to specifically ZARONIA as the replacement rate, just the replacement benchmark, but it does indicate each party's intention to transition, because they apply this sort of amendment approach, which is also one of the approaches that can be adopted for fallbacks. Parties, as I've said before, will be required to amend this language at a later date to include the specific terms in terms of methodology, your conventions, etc. The LMA has more recently published the rate switch exposure draft. This language includes hardwired fallbacks. So we see, ZARONIA being referenced in there, as a replacement rate, built in all the necessary provisions around your conventions, the methodology, how you calculate, as well as an automatic switch mechanism. And that automatic switch mechanism just speaks to when the transition will take place, the agreed date that the transition will take place. For example, on the actual cessation date that may occur. Fallbacks in loan agreements have to be bilaterally negotiated and agreed. It is very different to what we've seen with ISDA, the approaches that ISDA have taken, because there's an automatic transition by virtue of your definition and your protocol. In the loan world, you have to agree this by amendment or in your agreements. So this is always seen as an active transition by virtue of the fact that they are bilaterally agreed in an amendment or in a new agreement. So I think that basically covers the questions related to the legal issues that we've seen.
Thank you, Kim. That was very thorough. Before I move to the Q&As from the Q&A tab, our last prepared question is on how will syndicated loans be managed, and I will hand over to Kate to address that.
Thanks, Carol. As Paul mentioned earlier, Standard Bank is an MPG member, along with other local South African banks and participants. Therefore, we will be working towards the same timelines and the same milestones, and we will communicate with our clients via the facility agent on these transactions. The best thing to do if you have ZARONIA-related questions on your syndicated facility is to ask the facility agent, who will be able to coordinate these communications between the lender group and the borrower. Thanks, Carol.
Apologies, we're having a few technical difficulties today. If I move to the Q&A tab, the first one, I'm going to pass back to Kim. So it just loads, apologies. Can ZARONIA be early adopted in new loan facilities negotiated in 2025?
I think this was touched on also in the milestones where we saw ZARONIA first for the loan market. So yes, I mean, ZARONIA has been published, it's been endorsed by the regulators, etc. So there's nothing stopping, entities from referencing ZARONIA. But I think one of the key considerations when those milestones are put together is, derivatives first, and there's specific reasons for that. For example, liquidity in the market, etc. So nothing stopping parties from actually, referencing ZARONIA in all new contracts. But I think it's encouraged to try to keep as close to those milestones as possible for the reasons. I mean, there's a lot of thought going into why those are done at each stage.
Thank you very much, Kim. The second one around credit adjustment spread. Paul, I think maybe you can take this one. The question is this negotiated by the parties? Because now in the example, it was on Vawani's slides, I believe, the ZARONIA product is now more expensive than the JIBAR product.
Yeah, thanks, Carol. I think that's such a good question. And, that will be very much a topic of discussion between banks and their counterparties in terms of lending transactions. There is a lot of underlying nuance to that question. For example, at the moment, we're in a rate cutting cycle, so we'd expect JIBAR to be lower in ZARONIA. It is predictive in terms of pricing in the expected rate cuts. So you have a timing difference, but overall, the credit adjustment spreads are there to try and set the interest rate over a period of time to be similar or the same. The credit adjustment spread is very much is put in place to try and standardize transition. It's there as a tool that is really built by the market for the market to say this is our best adjustment that we think fits our market, aligns with the ISDA principles and the way ISDA's adopted it from a ISDA fallback protocol perspective. But it doesn't mean that those conversations shouldn't happen with the bank, as an example, around what the appropriate interest rate is for a particular transaction.
Thank you, Paul. I think the next one is also coming your way. If the adoption timeline for derivatives and debt facilities differs, how will this impact the ability to hedge effectively or use hedge accounting?
Yeah, thanks. And that's why I think it was critical in industry level that we felt that we should get the derivative market up and running first. We have obviously a very active JIBAR linked derivative market. Our swap market is based off 3-month JIBAR as the underlying interest rate. We're effectively building a full new overnight index swap market linked to ZARONIA. And without that in place, I think it is difficult to, consider building a loan market where hedging might be required. So we would expect to see liquidity build up in the derivative market, which can then support hedging of ZARONIA linked loans at a future state. So that's why the sequencing is as it is with derivatives ahead of loans and bond markets.
Thank you, Paul. Makes sense. The third question was around, will there be a term equivalent? But I believe you did address it earlier on in the slides. And lastly, why don't we set the effective rate? I'm not sure that's supposed to be C. Like what happened with LIBOR to SOFR should be much cleaner and predictable.
I think that relates to the credit adjustment spread process. We expect the credit adjustment spread will most likely be a 5-year look back, very much like what we've seen with LIBOR. So look at the spread between JIBAR and ZARONIA over a 5-year look back. that rate will be published as soon as the SARB and the MPG are comfortable that it is fit for our market. We would think that it's better to align with the ISDA approach, which will mean that we can use the ISDA fallback protocol. As soon as that SARB are comfortable with that credit adjustment spread, that rate will be published for each of the JIBAR tenors, so 1-month JIBAR, 3-month JIBAR. The spread between those JIBARs and ZARONIA will be published on Bloomberg and other data vendor providers, and it will be fixed when cessation is announced. And as you can imagine, as we're building up new product capability for ZARONIA in the derivative market and the loan market, there is potential for potential delays with market infrastructure providers, with system vendors. So all that information is important, and that we keep some flexibility in the timeline. But we will have clarity on that credit adjustment spread when the cessation is officially announced, and that will be important. So I think we will have that, but that's only likely to be at the end of 2025.
Thank you, Paul. It's quite a detailed question, but fundamentally, the question is around, will the different banks and the different departments ensure that the credit adjustment spread is consistent to ensure that clients aren't negatively impacted when they have a fixed rate loan? Sorry, I'll pass that to Bongani.
Yeah, so that's a very important question, in particular as you get ready for transitioning, to ensure that there's harmony, specifically where there are products that are linked together. To answer your question, one should expect that where both a loan or an underlying as well as its derivative are being transitioned, that those get transitioned at the same time, and for the terms to be nearly matched as much as possible. As Paul mentioned, the credit adjustment spread, a standardized credit adjustment spread methodology allows for transparency as well as ensuring that both market participants adopt a similar approach in terms of transitioning. To the extent that banks as well as borrowers or lenders agree on transitioning using the standardized approach, then that will make it cleaner and ensure that both the loan as well as the underlying swap, as mentioned in this example, are transitioned on the same terms as well. There may be instances where counterparts may actually wish to negotiate differently with respect to what their credit adjustment spread should be or the terms of actually transitioning. And that's important to take into account to the extent that your negotiation for your loan as well as your swap are different, because there will be basis risk or difference in rates calculation to the extent that you negotiate a different rate spread in that regard.
Thank you, Bongani. I don't see any more questions. If anyone does have anything further, or you think about something after this webinar, please do refer to the resources that Paul mentioned earlier, and specifically the Standard Bank website, which will have a very detailed FAQ section on ZARONIA. Otherwise, please do reach out to your client engagement team. I'm going to hand back to Doug now for some closing comments. Thank you.
Thank you all very much for joining us for our second planned webinar on Rand rates reform. Hopefully it has brought you up to date with our latest developments, the key timelines, risks to be aware of, and the important areas to focus on. We look forward to engaging further through a combination of additional webinars, updates to our website, and direct engagements as we support our clients through this important transition journey.